JEPI's yield looks amazing, but is it actually safe to depend on for retirement income? JEPI has become one of the fastest-growing income ETFs in the market, attracting billions of dollars from investors searching for dependable cash flow. The appeal is obvious. Traditional dividend ETFs may offer yields between 2% and 4%, while JEPI has often delivered substantially higher distributions. For retirees, that difference can appear transformative. A portfolio generating twice or even 3 times the income could potentially reduce the need to sell shares during retirement. But high yield alone does not create reliable retirement income. Many investors see the distribution rate and assume the income stream is as dependable as a traditional dividend from a dividend aristocrat. In reality, JEPI follows a completely different strategy, and understanding that distinction is critical before depending on it for decades of retirement spending. Because the real question isn't how much JEPI pays today. The real question is whether that income can remain reliable through changing markets, economic cycles, and retirement horizons that may last 20 to 30 years. At first glance, JEPI appears almost tailor-made for income investors. The ETF owns a diversified portfolio of large-cap U.S. equities, while simultaneously generating option premium through an equity-linked note structure tied to covered call strategies. This combination creates 2 income sources. First, investors receive dividends generated by the underlying stocks. Second, they receive option premium income collected from selling market upside. The result is a distribution yield that frequently exceeds what investors can find in traditional dividend-focused ETFs. However, that extra income is not free. Every investment strategy involves trade-offs, and JEPI's higher yield comes with a cost that many investors overlook when comparing yields alone. Understanding that trade-off may determine whether JEPI becomes a valuable retirement tool or a disappointing long-term investment. To understand JEPI, investors must understand where the income truly comes from. Unlike traditional dividend ETFs that rely almost entirely on corporate dividend payments, JEPI supplements stock dividends with option premium generated through covered call exposure. When markets remain flat or moderately positive, this strategy can work exceptionally well. The fund collects premium income while maintaining exposure to high-quality companies. But there is an important consequence. When markets rally aggressively, some of the upside is effectively exchanged for current income. In other words, JEPI intentionally sacrifices a portion of future growth potential in exchange for higher cash distributions today. For retirees prioritizing income, that may seem like a reasonable compromise. Yet retirement is not only about generating income today, it's also about preserving purchasing power over decades, raising an important question about long-term wealth accumulation. One of the biggest misconceptions surrounding JEPI is that a higher yield automatically means greater retirement income security. In reality, total return matters just as much as current income. Imagine 2 portfolios. One generates a 10% yield but grows slowly. The other generates a 3.5% yield while achieving significantly higher capital appreciation over time. After 15 or 20 years, the lower-yielding portfolio may actually produce more annual income because its asset base has grown substantially through compounding. This is where investors must be careful. JEPI's covered call strategy can create excellent income during certain market environments, but it can also limit participation during powerful bull markets. That does not make JEPI a poor investment. It simply means investors must evaluate the strategy based on total return objectives rather than yield alone. And that brings us to the key question retirees care about most. Can JEPI's distributions remain dependable over time? The encouraging news is that JEPI's income stream is not solely dependent on corporate dividends. The option premium component creates an additional source of cash flow that can help support distributions even when dividend growth slows. However, investors should understand that distributions are not fixed. Option premiums fluctuate, market volatility changes. Income generation varies from month to month. As a result, JEPI's distributions can rise or fall depending on market conditions. This is very different from many dividend kings that have increased payouts for decades regardless of economic uncertainty. Retirees expecting a perfectly stable paycheck may be disappointed. Retirees expecting a variable but potentially attractive income stream may find the strategy much more appealing. The distinction is subtle, but it is enormously important when planning retirement spending. Consider a hypothetical investor with a $500,000 retirement portfolio allocated entirely to JEPI. Assuming an average annual yield near 8%, the portfolio could generate approximately $40,000 in annual income before taxes. That level of income is understandably attractive. But retirement outcomes depend on more than current distributions. Inflation continues to increase living costs. Healthcare expenses rise. Unexpected financial needs emerge. If portfolio growth lags inflation for extended periods, purchasing power may gradually erode despite strong income generation. This is why many retirement planners view JEPI as a complement rather than a complete solution. Combining income-focused assets with growth-oriented investments may create a more resilient balance between present cash flow and future purchasing power. And that balanced approach becomes even more important when evaluating the risks. Every income strategy carries risk, and JEPI is no exception. The first risk is yield chasing. Investors may become overly focused on current income while ignoring long-term total return. The second risk is distribution variability. Unlike fixed income products, monthly payments can fluctuate. The third risk is opportunity cost. During strong bull markets, the covered call strategy may limit upside participation relative to broad market indexes. The fourth risk is concentration of expectations. Some investors build entire retirement plans around a single ETF, creating unnecessary dependence on one strategy. Perhaps most importantly, investors should remember that JEPI was designed to balance income and volatility reduction, not maximize long-term capital appreciation. Understanding the fund's objective is essential because unrealistic expectations often lead to poor investment decisions, which leads to the final verdict. JEPI can be an effective retirement income vehicle for investors seeking higher current cash flow and reduced portfolio volatility. Its combination of high-quality equities and option premium income creates a unique structure that has proven attractive in a wide range of market environments. However, JEPI is not a magic solution. It is not a guaranteed income stream. And it is not a substitute for a diversified retirement strategy built around income, growth, and risk management. For many retirees, JEPI may work best as one component of a broader portfolio rather than the entire portfolio itself. The investors most likely to succeed with JEPI are those who understand exactly what they are buying, why the income exists, and what trade-offs accompany that yield. So before you invest, ask yourself one question. Would you rather maximize income today, maximize growth tomorrow, or build a portfolio designed to achieve both? Share your thoughts in the comments below. If you enjoy deep dividend analysis, retirement income strategies, and long-term wealth-building research, make sure to subscribe to our channel and turn on notifications so you don't miss future breakdowns. This content is for educational and informational purposes only and should not be considered financial advice. Always conduct your own due diligence and consult a qualified financial professional before making investment decisions.